If you're retired or looking to retire in the near future, I have 5 tax tips for you that you want to look to employ before the end of the year. And I also have a bonus one at the end, which is the most impactful one and could save you tens to hundreds of thousands of dollars depending on your situation. So make sure you stay tuned for that. The first tip is to split your CPP, your Canadian Pension Plan, or QPP, your Quebec Pension Plan, depending on where you live and what you're collecting here in Canada. Now, if you're married or common law and both of you are collecting either CPP or QPP, and there's a lopsided amount, meaning one of you is collecting more than the other, you might want to think about splitting it. And this is something that you have to apply with Service Canada, have it split at source. Now, the amount that you can split is depending on how long you've been together. There's some factors there. We'll link this video above, which we've covered there. But if there is a bit of a lopside in the amount that you collect for CPP, and you're unable to do proper income splitting with your other income sources, consider applying with Service Canada to have it split at source. So let's say one of you is collecting $800, the other person's collecting $400, then you can change it so that you both collect $600. It's not always perfect, again, based on how long you've been together and some other factors, but for the majority of you, if you've been together for a while, you could probably split it so you collect close to equal to help reduce the tax bill for the higher income earner. This is a quick and easy way for a lot of Canadians to level out their income between their spouses. Now, again, if you have other sources of income that you could income split, it's an easier way to do it. But if you're stuck in between a rock and a hard place and not sure how to kind of level out income between you and your spouse or partner, splitting your CPP or QPP can be a good solution for that. The second tip I have for you is to make sure you utilize the pension tax credit. So the first $2,000 of eligible pension income, we'll link below what eligible pension income is so you can learn all about that. But you want to make sure that you have at least $2,000 of eligible pension income so that you can use that income tax credit on your tax filing. Again, make sure your spouse or common law partner does the same thing, or you can actually claim more of yours and utilize it on theirs. Again, there's some rules around that, but if you qualify, make sure to do that. It's amazing how many people we meet, we do a plan for, and they're not taking advantage of that. So make sure you understand the pension income tax credit, which we have a full video, we'll link that above, to learn about how the credit works. And then make sure you actually are utilizing it within your retirement plan. The third tax tip I have for you is if you're turning 71 this year, which I understand is a small percentage of you, but if that's you, you need to convert your RSP to a RRIF before the end of the year. Now, if you've done proper tax planning and you haven't been working for a while, hopefully you did this a while ago, but in the year you turn 71, you were forced to convert your RSP to a RRIF. It will also be the last year that you can actually contribute to your RSP. So again, think about converting that RSP to RRIF before the end of the year and look at what your payment requirements are going to be going into 2025 to figure out how that integrates into your overall cash flow planning heading into the new year. Speaking of RRSPs, my fourth tip for you is even if you're over 71 and can no longer contribute to your RRSP, if you have a spouse or common law partner under age 71, you can actually contribute to their spousal RRSP if you need the tax break. So there's a bit of tax planning. Again, a bit of a nuanced situation there, but if you are past that age 71, need some tax planning tools, you can contribute to a younger spouse through a spousal RRSP. The fifth tip I have for you revolves around your investments. And for a lot of you, you bump into OAS clawback or old age security clawback. And that is really where you have too much income, you in 2024 over $91,000, and you're getting clawed back 15% on every dollar. Now that's costing you free money. And for a lot of you, you bump into old age security clawback. Sometimes it's from pension and RRIF withdrawal and all of that, but for a lot of you, if you have non-registered investment accounts, the income that you're earning on that non-registered investment account is what's causing your clawback. So if you have a defined benefit pension plan or RRIF income coming in, there's some incomes that you can't really manipulate too much. But if it's a non-registered investment account and you're earning interest income, maybe you need to rejig that to more of a capital gain structure or dividends. Again, there's the Canadian dividend gross up does apply, so that can affect your old age security clawback as well. But take a look at your overall investments, how they're structured, what your overall goals and objectives are within those accounts. But there might be a bit of tax planning strategies within the investment accounts themselves. So again, talk to your investment advisor to figure out what is a better investment solution so that I can actually get my old age security and not be clawed back, or at least not clawed back as much. We see it all the time. There's a lot of strategy here to be had and a lot of money to put back in your pocket. So if you're somebody that's bumping into old age security clawback, you have a non-registered investment account, maybe you can rejig things a little bit to get some of that money back through your old age security. The sixth and final tip for you, in my opinion, is by far the best, but I get a lot of people's feedback around donations and tax savings there. So in Canada, we have it. So if you make a donation, you get a tax credit, meaning that at the end of the year, when you do all your taxes, if you owe $10,000 in tax, but you've made a donation, you get a donation tax credit for that, and it reduces the tax amount owing. Now in Canada, it works out to about 46%, plus or minus a little bit, depending on how much you give, but let's call it 46%. So if you gave enough to get a $4,600 tax credit, your $10,000 would be reduced down to $5,400. Now, for a lot of you, we've had a couple really good years in the stock market, and a lot of you have made a lot of good money on your investments. And if you're somebody that's sitting there with a large gain on a non-registered investment, and you're sitting there saying, look, my $50,000 investment over the years has gone to $100,000. In fact, we were doing a plan for a client today that their $200,000 account has gone to $2 million. And again, that's over many, many, many years. This person was in their 80s, but there's a tax issue there. So one strategy you can employ, and you can do this at any level. Maybe your $1,000 went to $2,000. Maybe your 100 went to 200, 50 went to 100. Doesn't matter what it is, the strategy works regardless. So if we take the $50,000 investment going to $100,000 for an individual in a non-registered account, if they were to sell that $100,000 of investment, they would be paying capital gains tax on $50,000 of it. Now, I get it. Even after you pay tax, so $50,000 gain, personally right now, as long as it's under $250,000, 50% of that is taxable. So you have $25,000 of additional income this year if you were to sell that $100,000 stock. If you're in a 50% tax bracket, you're paying $12,000 of tax. So it's not the end of the world, but a strategy for you if you're someone that wants to help out charities. Again, we talk about social programs here in Canada and the lack thereof. A lot of our social programs that you see around your community are run by charitable organizations, and they're doing good work around you. But of course, those charitable organizations rely on funding from you, from me, from everyone. And so if you're someone that sees some charitable organizations around you doing good work and you want to support them, you can actually donate those shares in kind. Now again, I'm using a big number here in 100,000, but it could be, I want to donate 1,000 or 2,000 or a few $100s. Any amount works. But let's say that $100,000, if we donate that $100,000 of, let's say, Tesla stock as an example, I paid $50 for it, it's now worth $100,000. I have a $50,000 gain. Now, when I donate that $100,000 in kind, I don't sell it, I just transfer it to the charity, I will get a donation receipt for $100,000, which will save me roughly $46,000 in taxes. Fantastic. Yes, my $100,000 is gone. I've given it to the charity. And so when you give money, yes, I'm saving the taxes, but I'm out all that money. But that's okay. I've decided to give that money away to help, again, a charitable organization that's doing good work. So there's a tax savings. So first off, I'm giving the $100,000. I'm going to get a charitable receipt for $100,000, which saves me about $46,000 in taxes. Secondly, my $50,000 gain, I don't pay that. By transferring that asset to the charity, I avoid paying the capital gains or paying tax on any of the gains on that stock. The charity as well would sell the stock right away, and their cost base is $100,000, and they don't pay tax. So there's a double tax benefit. And I've talked about this a few times on the channel before, but it's one of the rare occurrences where it actually is allowed from CRA, where there's a double tax benefit. So I avoid paying the capital gains tax. I also get the full $100,000 donation credit. So again, I might say, well, I want to save the taxes and I want, if that stock's done well, I want to liquidate it and get it into charity. But maybe I don't want to give that whole $100,000 at once. Well, there are what's called donor advised funds, and I won't jump too much into it here, but I use one myself where we put money into the donor advised fund, meaning that I'm donating that money, it sits in a pool, and then I can give it out over time. So maybe I want to help multiple charities over the year, over many years. And so there's different strategies you can employ. Now, I use a donor advised fund called GiveWise, and we'll link that below. GiveWise is a great program. It's basically a warehousing for your donation. So you put money there, but what I like about it is before my wife and I were giving donations to a bunch of different charities, and I'd have to kind of keep track of all the donation receipts and are they coming in, and come tax time, it's very complicated, very messy, and very disorganized, to be honest with you. Well, now with GiveWise, I can give all the money that we're planning to give to GiveWise, and then I give it out to the charities from there. But it's GiveWise that actually gives me my donation receipt. GiveWise also takes stock in kind. So again, if I have appreciated assets in some of my investment account, I can donate that to GiveWise. They will liquidate it, but I get the credit. So again, that $100,000, I would do it through GiveWise. So if you're looking for a solution for this, check out GiveWise. There's many other ones out there as well, but that's the tool I use for this program. So again, a lot of you have these big gains, you have big tax bills, you're not sure how to reduce your tax bill. Giving money, yes, when you give money, it's gone, don't get me wrong. But it's helping, hopefully, if you give it to the right cause, a great cause around you. It's making a difference in your community, and it's supporting social programs that our government are just never gonna support. So we need these charities and these organizations to run these social programs for our communities, for our kids, for families in need, for all these things that are going on in your community. So for those of you that have a heart to give, a heart to help those social programs around you, and also are looking for a bit of a tax savings, considering looking at something like GiveWise, giving to a charity, setting up a donor advised fund, however you want to do it, you can make a difference, but it saves you tax money and helps a social program in your community.